Another method for finding out the valuation of a company is the discounted cash flow method. This method calculates the investment value based on the anticipated or future projection of the cash flow. Typically 3 to 5 years of projections are taken into account because beyond that it's really hard to predict what will be the future cash flow look like. Now since these projected cash flows are based in future, they can't be used for finding out the valuation of the company, so they are discounted back to their present value, and the summation of the discounted cash flow gives us the valuation of the startup. Now the discount rate that is used is based on multiple factors such as the market risk, the amount of debt that company is having, and return that company needs to generate. We will see how it is calculated in the coming section. Here is the generic formula for calculating the discounted cash flow for n years. N could be the period number, which includes the number of years for which the cash flows are projected, and R is the discount rate, which is the rate of return used to discount the future cash flows back to their present value. Now before learning about how to calculate discount rate, we need to learn about two of the important terms that are used in discount rate calculation. These are cost of equity and cost of debt. Cost of equity is nothing but the return that company needs to generate on its equity to the investors to justify their investment. So one of the well-known method, which is capital asset pricing model, is used to calculate the cost of equity. Basically, this model tries to estimate the return needed on equity given an amount of risk involved. Now the following equation can be used to calculate the cost of equity. The terms that are used in this equation are risk-free return rate. This is the minimum rate of return that investor can get without any risk. The government treasury bill is considered as the safest investment, and the interest rate that it gives can be considered as the risk-free return rate. The term beta here represents the systematic risk, which is basically the volatility of the asset with respect to the market. If beta is less than 1, that means asset is more volatile relative to the market. If it is 0, then the asset is neutral, and if beta is greater than 1, that implies that the asset is more volatile in relative to the market. The term MRR represents the market rate of return. It is the rate of return of the comparable asset in the free market. Now when we subtract the risk-free return rate from the market return rate, then we get the market premium or the equity risk premium. This equity risk premium is the excess return that an investor earns by investing in the company compared to investing in the risk-free asset. So higher the risk, higher will be the beta and higher will be the market premium. Thus, it will result into high cost of equity, which implies higher return to justify the risk on investment. Now company can also raise capital by taking the debt in form of business loans or by issuing bonds at the fixed interest rate. Now cost of debt is nothing but the effective interest rate that company has to pay on all of its debt that it has taken. Here is the equation given for simple cost of debt, which is taking the business loan at particular rate of interest. So multiplying the loan amount by rate of interest will give us the simple cost of debt. Now these interest expenses on the company debt can be tax deducted as they are considered as business expense and can be used to save tax. Now cost of debt after tax amount can be calculated by multiplying the simple cost of debt by 1 minus tax rate. This tax rate is the rate at which the business is taxed. When company takes loan and use the money correctly, and the loan amount can generate the net income which is greater than the cost of debt after tax amount, then the loan taken is advantageous or beneficial. And finally, cost of debt after tax rate can be calculated by dividing the cost of the debt after tax amount by the total debt that the company has taken. This is the effective interest rate that business needs to pay on all of its debts. One important thing to note here, the loan amount will get amortized, which means it will reduce after each installment payment. Now as the company capital structure consists of debt as well as equity, so for the discount rate, weighted average cost of capital is used. The weighted average cost of capital illustrates the required rate of return for an investment in the company, which has both debt as well as equity in its capital structure. As we have seen earlier, the discount rate is applied on the projected future cash flows. Here cash flow implies the free cash flow to the firm. The free cash flow to the firm describes the money that is left over for investors after the firm has paid all its expenses, taxes, and invested in short-term assets like inventory and long-term assets like equipments. So free cash flow to the firm belongs to the bondholders or creditors who have given the loan or debt to the company and shareholders who have invested in the company equity. Here is the formula for weighted average cost of capital, in which cost of equity is taken in proportion to the equity percentage and cost of debt is taken in proportion to the debt percentage, and both are added together to get the final weighted average cost of capital, which will be the discount rate for the calculation of discounted cash flows. Here is the example of discounted cash flow, in which an initial investment of 15 lakh is made in a project and cash flows are projected for the next 5 years. The discount rate is 8%, and the third column shows the discounted cash flow, which is calculated on top of projected cash flow based on the discount rate. Adding all the discounted cash flows for 5 years, we get the final amount, which is the discounted cash flow sum of 15 lakh and 14,996 rupees. And when we subtract the initial investment, which was 15 lakh, from the discounted cash flow sum, which is of 15 lakh 48,996, we get the resultant net present value, that is 48,996 rupees. Here net present value is a positive number. The positive number implies that the money generated in this project is more than the initial investment. Higher the amount of net present value, higher will be the return on the investment. Another integral part of the discounted cash flow method is the terminal value. The terminal value gives the value of the company beyond the forecasted cash flows. Since it's really hard to forecast cash flows beyond a certain period of time, there are two methods are used to calculate the terminal value. These are perpetual growth method, or it is also known as Gordon growth model, and second way is exit multiple method to calculate the terminal value. Now the perpetual growth method, which is used to calculate terminal value, makes an assumption that the business will generate the cash flow at the constant growth rate forever after the period of projected cash flows. Here is the formula for calculating the terminal value using the last projected free cash flow to the firm and then multiplying it by 1 plus growth rate and dividing the result by difference of discount rate and growth rate. The second method for calculating the terminal value is the exit multiple method. The exit multiple method assumes that a business will be sold, so in order to calculate the terminal value, it takes a financial metric like company EBITDA and multiply by it a factor to get the terminal value. Now this factor could be derived from the similar firms that were recently acquired. The calculated terminal value has to be adjusted to the present value using the discount rate of the last projected year. We can use the discounted cash flow formula for adjusting the terminal value to the present value using the discount rate of the last projected year, which is N. And last, enterprise value, which is the value that estimates the potential acquisition cost. It is based on the capital structure of the business, which could be derived by adding the equity value and value of debt and subtracting any cash or cash equivalent from it to get the total enterprise value. The enterprise value can also be derived from the discounted cash flow method. As we have seen that discounted cash flow method has two parts. The one is the projected cash flows for n years and second one is the terminal value. Now enterprise value can be calculated by adding the sum of discounted cash flows for n years and adding the terminal value, which is adjusted to the present value, to get the enterprise value. Here is an example to calculate the enterprise value using the discounted cash flow method. Here the cash flows are projected for the 3 years and sum of discounted cash flows for all the year is given as 1,27,000 rupees. The weighted average cost of capital is 10% and last forecasted free cash flow is 60,000. The growth rate for calculating the terminal value is given 4%. Now to calculate the enterprise value, we will first calculate the terminal value using the formula of perpetual growth method and it comes out to be 10,40,000 rupees. Now this terminal value has to be discounted to the present value using the discount rate for the last year, which is the third year, and the adjusted terminal value to present comes out to be 7,81,367 rupees. Now the enterprise value is the sum of discounted cash flow for all the years and adjusted terminal value, so which is 1,27,000 plus 7,81,367, which gives the enterprise value as 9,08,367 rupees.